Okay, so we have CAPM, arch, I call it arch, options and value at risk. These four topics I want to kind of dive into, and beyond just the math of it, I want to talk about their implications, the real world value, and stuff like that. So, starting with the capital asset model. So the capital asset pricing model, it's kind of like, so the model first makes an assumption. It assumes everyone is rational and that like transaction costs or fees don't exist. So supply basically just equals demand. Just kind of to simplify everything, although that's not the case in reality, but this is how we model the model. So it's basically a formula that describes an ideal world where it ends with a hypothesis that all reward that you get comes from a certain type of risk, and that's market risk and nothing abnormal. And that's what we call beta. So there's two types of risk. There's systemic risk and unsystemic risk. Systemic risk is risk that can be justified by market movement and things you can't really control, and it's not unique to you. So it could be some economic downturn, the entire economy is in recession, you can't really control how prices move, or you can't control how your portfolio is diversified and your assets in the portfolio. So the market rewards you for that risk because you can't do anything about it. Then there's unsystemic risk. Unsystemic risk is risk you take that the market won't reward you for. That risk could be you like the company that you have most of your money in, the CEO just abruptly quits, so the stock crashes. It's considered a risky stock, as there's going to be volatility from that point, but it's a unique type of risk, and the market doesn't really reward you for that. Now, what does it mean for the market to reward you? So let's start by talking about beta. So beta is, I guess, to understand the CAPM model, it's important to understand beta and just like standard deviation. So So let's take two examples. We have stock A and stock B. Okay, I don't know why. All right. Stock A, stock B. Okay. So let's assume stock A has 50% volatility. So it's a very volatile stock. It's risky. You probably shouldn't work with the stock. And let's assume stock B has 20% volatility. Now, when a stock's volatile, like the idea is you either could get a very big payout or a very big kind of fallout from the stock because of its erratic movement. But what beta is in this like kind of sense is stock A can have 50% volatility, but its beta could be like, well, near zero. Beta near zero, while stock B has a beta that's like 1.5. What we can say about stock B is the way that it's moving is aligned with the market and more. So if the market as a whole experiences like a 10% increase in value, this stock is going to experience a 15% increase in its value. That's basically what it is. Um, 15%, yeah. Stock A, because it has a beta 0, it's uncorrelated to the market. So this stock by itself, although it's 50% volatile, if the market like increases 10%, this is just gonna do its own thing. It's kind of stubborn in that aspect. And what it means by you get returns from this beta but not this beta. You get returns from this stock and not this stock, given that this stock is risky, still 20% volatile. That 20% volatility is accounted for the risk premium on the stock. So here there's no risk premium. Its beta is near 0. The market has nothing to do with the fact that it might crash. But here, because again we can't control exactly like what we're doing, or we can't control how it might like be how it might like how risky it is, because it's correlated to the market. The market accounts for this high beta into its price, and you, for example, can say that because this is a risky stock, I can buy it at a discount. For me, it's a discount. That's the risk premium. So I want to get the stock at a certain amount. I can now get it for cheaper. Let's say like $90 when its actual value is 100. So my return is $10. And well, no, my return isn't $10. So I bought it for 90 while it was at 100. It goes up to like 110, for example. Then I get $10 return on the 90. So the return's really like 11%. So that's basically that's like the story behind it. So what the CAPM basically is for is it's assuming that whatever portfolio you have has no alpha. And what's alpha? That's kind of the opposite of beta. It's not the opposite in like the mathematical sense where it's like 1 minus beta, but alpha being 0 is accounted for here. I'd like to show. Okay, so when you test the CAPM model against something, you test the return of stock J, like at some time. That return equals alpha of J plus beta of J times the market return plus the error term, which is white noise. So here we're assuming in the CAPM when testing it that A equals 0. That's kind of like the null hypothesis of the model. And when A equals 0, and this cancels out, everything, the beta with the market return plus whatever error term is justified by beta. So at a loss, at an increase, at whatever the return might be, it's all justified by beta, and alpha has nothing to do with it. If alpha is greater than 0 in this, where it's like a positive number, we can call that stock undervalued. That means it returns more than the risk said it was going to return. Because if this is a positive value adding to this positive, the return is just going to be higher. And if alpha is less than 0, it's overvalued. So you don't want alpha being more than 0 could be that it's undervalued, or there's some sort of skillful manager, like where you saw something people didn't, whatever, his stock was undervalued, so you bought a lot to get higher returns. But regardless, like, this isn't a model of what you would want. Yeah, you would want a stock to be undervalued, and only you see that, but this is just what the CAPM tests. So, an example of something like this is, let's pick what we would think is an overvalued stock, and let's see, testing its CAPM, is it an overvalued stock? So here I have Palantir as a stock. So I don't know, it's like that. So Palantir is very important to distinguish. There's two types of multipliers. It has two types of multipliers that's driving its stock price very high. We have the valuation multiplier and we have the risk multiplier. So it's said that its beta, its risk, correlated to the market, is 1.5. It's between 1.5 to 3. I'm just going to assume it's 1.5. But like I read somewhere that it's around 1.5. Which means that the stock is 50% more volatile than the market. If it's to go up 1 unit, it's going to go up 1.5. Same with down. Its valuation multiple, I'm just going to say V, is 300x. What this means is investors want to pay around $300. I think it's a little more, but around $300 for every $1 profit that Palantir makes. It's kind of just a bet that they're going to just make a lot of profit. And that the 300 is like the important thing to distinguish is the valuation multiple and the risk multiple are very different, and I don't know who confuses them, but it's said to be confused. I don't know, makes sense to me. That the 300 is based on the stock's price to earnings ratio, and this is based on its volatility in connection to the market. So, in both regards, this stock is very volatile, and when something has this high of a valuation, if they miss earnings, like their quarterly earnings, by like $1, the whole stock might crash. I mean, I don't know about $1, but yeah, like it's very fragile, and that's kind of the drawback with high valuation earning, multipliers. So it's overall not a smart decision because you're gonna be like having a headache, having to deal with it. So how big is that headache? We can see that. So this is return. I don't know, like expected return, whatever. This is return of a stock. Return of Palantir. Let's just do this. Yeah. This also stands for portfolio. So whatever. J is Palantir. So the return of Palantir stock has to do with the return of the risk-free rate, and then beta times market return minus the risk-free return. And okay, let's assume that the risk-free return is 4%. That's 4. And beta here is 1.5, as we said. And the like market return is 10%. So in this case, like with these assumptions, what can we say about this stock? Well, we could say that 0.04 plus 1.5 times 0.1 minus 0.04. This equals 0.13, which is 13%, which means if you are to buy Palantir stock, some amount of shares, you would expect a 13% return minimum. So to make up for the headache of keeping the very risky stock. And this just isn't, well, okay, 13. Which just isn't a good decision. But like I'm not, who am I? I don't know what I'm talking about. So let's just move on. So the CAPM kind of gives us, like I used it more to build the intuition and refresh memory. But yeah. So next, I'd like to talk about the arch model. And what is that? I'm not going to write it here because I take so long to use this chalk. I expected to have a whiteboard, but whatever. This is the autoregressive. Actually, maybe I should write it because it's a very long. Okay. Autoregressive conditional. Now this is the hard word. Heteroskedasticity. Heteroskedasticity. Where this basically means that variance is not constant. So this is an AR model similar to the AR1 model, which is kind of like a prerequisite for this. Where this is called the arch model, arch1 model, whatever, with the addition of conditional heteroskedasticity, which is, variance is not constant. So what does that mean for variance not to be constant? Here what we're saying is, so in other models we assume constant variance. And the error term E, like how we said in the CAPM, is white noise. It's random. And this basically implies that every time that you test, like every day that you're testing against this random error term, the market is like nervous every day the same amount. And like that's, I guess, what variance is in these equations, where the higher the variance, the more nervous the market is. Where like you're more bound to have for like risk, whatever. I say a lot. Okay. So the reality is the market isn't equally nervous every day. So what the arch model basically does, and I'll first write its variance equation and then explain its intuition. Yeah, T, yeah. The whole point is that time is a factor in this. 0 plus 1, 2t minus 1. Okay, so variance, which is the standard deviation squared, equals, this is a different alpha. It's confusing, whatever. I think it's a different alpha. Yeah, it is, because this is so this is background variance in the market. So it's like the like already existing background variance in the market, and this is a movement. Now this movement A2 time. I don't know why they couldn't have picked a different notation, whatever. I feel like I could have changed it, but I don't know the rules here. AT first, before AT minus 1, because this is minus 1. AT comes from the standard deviation of T times its error term. Right? Yeah. Where this error term is white noise. That is typically standard normal. So the mean is 0, the SD is 1 for the white noise. But this white noise is multiplied by the standard deviation of the time that we saw the movement. So okay, this is the movement. This being the movement means this is yesterday's movement. So to predict today's variance, we use yesterday's movement in it, like times the market background for that day, plus the market background variance for the day before. 0, 1. Wait, actually, I don't think this is the day before. It's just whatever. There's conditions to it. But before I get into the conditions of the two A's, what we're basically doing here is we're not predicting returns. We're not predicting if this is going to go up or down, if a stock's going to go up or down. We're not trying to, at least, with the arch model. What we're doing is predicting how much it's going to move, regardless of the direction. So think of it like just like a sailor that's, think of it like someone's just wasted. Someone's very drunk. And they're walking down the street, and some other type of model would try and predict, is he going to step left or right? He's drunk, he's unpredictable, you don't know, there's a lot of factors to that, if he's going to step left or right. As in, like, is he going to now start moving to the right or to the left? Well, like drunk people are like stumbling and whatever. So it's just hard to see. The arch model tests how big his stumbles are going to be, how big the steps that he's going to take are going to be, depending on the last steps. So if he is seen stumbling, he's probably going to continue to stumble until he like slowly calms down to like regain his thing after a lot of time. So if right now we see a stumble, or the last step we saw was like a stumble step, we're probably going to see another one. So that's what this model tells us. The behavior of like a stock's movement, regardless up or down, tells us how its behavior is going to be like later. And this could be very important for options, which we'll talk about, because you can put I'll get more into this, but you can place a call option on a stock's movement, not specifically just its price. And if you're able to accurately predict how big it's going to continue to move, regardless if it goes up or down, you would be winning in that type of return. So that's the arch model. So two important things about these A's. So A0 has to be has to be positive. I don't know why. Same with A1, has to be positive. They have to be positive because, I'll tell you why. Why do they have to be positive? Oh yeah, because variance can be negative. I don't know why I'm doing this. Okay, so these have to be positive because like the output just can't be negative, and if it's negative, that would happen. And then A1, so the one that's being multiplied to the movement, has to be less than 1. So this is basically like a 0 point something, like some decimal. And we need that to be the case to ensure that variance is stationary. Because this is just a key assumption in the arch model. Because if the arch model ever equals 1, meaning this is just 1, and we're letting the movement kind of decide the movement like completely, what's wrong with my hand? Then the variance will explode and shoot up to infinity, which we can't have. So we have to make sure that alpha 0, alpha 1 are positive, and alpha 1 is less than 1. And it can't equal 1. So, or if it does equal 1, it's just the variance is going to go up until forever. Okay. So we have two types of variance. I can leave this here. So we have conditional variance, where it's conditional to the time and the previous, where time's a factor. So it's conditional on the previous movement and stuff. and we have unconditional variance, which is kind of like the long run variance. This variance is given by just say bar of movement equals alpha. So if we want to see the variance, the long run average variance that doesn't change, we check it this way because these don't have time, kind of the time aspect to it. If we want to check the everyday variance, we use this. I can't tell how clear this is on the screen, but whatever, this is for me. Okay, so what we can say about the autoregressive conditional heteroskedasticity, where homoskedasticity is constant variant, which is what we assumed before. Yeah, so what we can say is that it's uncorrelated, but not independent. So it's uncorrelated in the way that yesterday's returns. So the like covariance between the correlation between the average return of today and yesterday equals 0. It's uncorrelated, but it's not independent because today's stock movement is dependent on yesterday's. So although returns are independent, like the price, the number is random, the returns themselves aren't independent from each other because they're going to move a certain way depending on the last one. So that's like a thing I guess people confuse. And something that this issue brings is it takes into account all the calm days and the days full of chaos. So when we're modeling this for any type of day, we're assuming there's going to be heavy tails, meaning like outlier moments, where it's going to have bad days be accounted for it, kind of like extreme events, the like black swan events that like usually we don't predict happen in these models, but in real life do happen. These create heavy tails because it's mixed between the model takes into account all types of kind of returns in that aspect. So in that way, it could be inaccurate. So what like analysts say are a better way to go about the arch model is the G arch model. This standing for generalized. My handwriting is terrible. So the generalized is basically just the arch model plus past variance. So yeah, plus past variance. So that's beta 1 variance of yesterday. So just to like kind of like refresh it, it's so given G arch, we have the return of J and then A0 plus A01 A T minus 1 plus B1 beta 1 T minus 1. So this is the addition in the Gorch model. Such a bad word. Yeah, and it stands for what recent volatility is going to look like. With this being kind of like the recent news, they're like, okay, this is what we know. Let's just add on what we think recent volatility is going to look like, depending on yesterday's variance times the like beta of today. So yeah. Have anything else here? Yeah, I mean that's basically it for the autoregressive. I just know this lecture is boring, but whatever. It's not for you. Okay, so options. Okay. So what are options? an option is kind of a contract that I sign that gives me the option to buy a price or sell to buy a stock or sell a stock at a certain price that I determine today. But I would then be able to buy or sell it for that certain price later. So if I think that, let's say I want to buy Apple at $100, like my option is I want to be able to buy Apple at $100, and there's a certain expiry date where I have to buy it from now until that expiry date. That's called an American option, while a European option is where I can only buy it on the expiry date. So I set a date where I will then have the option to buy it. If not, it expires. This has nothing to do with America and Europe. They're just called American options and European options for whatever reason. So options are important because if you think something's going to happen to a stock, or if you, I don't know, like just assume there's going to be good movement, bad movement, you can place an option depending on that and on the risk that you evaluate. So let's let me see. So how do we know what an option is worth? Because it seems baseless, but the way we price options is we do something called a replication portfolio. And this replication portfolio is where we make an actual portfolio of actual stocks of today's price and estimate the payoff of those of this new portfolio within the time date that we had for the option. And if and whatever that payoff is, we have to price the option based on today's portfolio, given the payoffs are the same. So if we project an option's payoff to be the exact same as a current replication portfolio's payoff, that option has to be priced the same as the replication portfolio. That's basically it. So that's like the core like thing about option pricing, at least. And the purpose of options, like or to price options accurately, is two things. We can hedge against something, so we have like sort of insurance. So we make sure that we can get a stock at a certain price, or we make sure that there's a premium that's paid to protect against a crash from the stock. And for speculation, like basically gambling or betting that a stock price is going to go up or go down. So it's important for that. Now, I forgot to mention the reason why the price of the option has to be the same as the replicate portfolio is if any of the prices are different, you could just sell the expensive one and buy the cheap one. That's like what the arbitrage aspect is to it, and that's why they call this rule the no arbitrage rule, or the law of one number, or whatever, where that price option is mathematically forced to be that specific number and can't change. Because once it changes, you could just buy the replicate portfolio, which is expected to have the same payoff for less, so your return is more. In options, we care about variance. We care about standard deviation squared. And the one thing that we don't know is future volatility. But we kind of have an understanding for the implied volatility, the VIX, the virtual implied, I don't know. It's like the index, the fear gauge. I don't know what the total thing is for, but yeah, the VIX. And we can say that if option prices are high, the implied volatility is high. The VIX is high. I know this. I know the abbreviation, but I forgot. Whatever. And this being high just means that the market is nervous. For option prices to be very high, it means the market is nervous and has to charge those extra fees because they think something bad's probably going to happen. So I just want to mention there's a difference between the option price being high and the strike price being high. The strike price is, it's called striking. Yeah, the strike price. So the market price is the fee that you're going to pay to get the option, and the strike price is the amount that you plan. So I want to place an option, a call option. So an option to buy, where a put option is an option to sell. I want to place a call option on Apple for $100, to buy it at $100, and to place that option, I will pay $5. So to have the right to buy Apple at $100, here's $5. So I'm giving you $5 as that's the option price to set it at a certain strike. So if that $5, if the average rate is $5 and then goes up to $15, that means there's a lot of people speculating something is happening, like something bad is going to happen. So it's the market's kind of reacting to that nervousness by shooting up the price of the options. So the main thing about options is the BOPM. That is the binomial option pricing model. So the binomial option pricing model gives us two things. So we have S1, today's price, current price, right? S2, the stock price when it's down, and S3, stock price when it's up. So, I think S0, whatever, yeah. I think it's S0. S0 is current price. S2 is stock price when it's down. S3 is stock price when it's up. So, there's like a kind of a setup for it. So first, before anything, we need to calculate the hedge ratio, which is like the delta. This is like the slope of the option price, of how it increases, where it's C up minus C down over S up minus S down, which is, I don't know why I said up, it's like 3 minus S2. So, like what we talked about, how it has to be identical. The C up and C down, whatever, that's the swing in the, so this calculates the difference in the option payoff, the way it's going to swing in the payoff of the option, and here in the payoff of the market, for the S1. And like we said, the payoff of the stock price. This is the option price, this is the stock price. This is the difference in the payoff of the option price, and this is the difference in the payoff of the stock price. Okay. So once we get the delta, it's now just a parameter in something else. So to calculate the option price is so say I want to figure out the call price. I do, so I don't get this wrong. So delta S1. Okay, so the current, whatever. This is S1. Delta S1 minus the delta of S2, the price when it's down, over 1 plus R, which is the interest rate. So it's just like the interest rate's 5%, this will be divided by 1.05. So we're modeling it. So we have to make sure it's important that we're getting the delta of the down price divided by the 1 plus the interest rate. And this, I guess this also simplifies to just S1 minus S2 over 1 plus R, with the delta being outside the bracket. I don't know how, whatever, like it's the same thing. And yeah, that's kind of the way that we calculate the option price. And this is the amount borrowed. Now, what is the amount borrowed? I realize it's my fault because I didn't address that. So what you're gonna do when you figure out like your plan is first you're gonna buy delta shares. So delta given what we just did, and then you're gonna figure out the amount borrowed, which is delta times S down over 1 plus R. Here, right? So that amount that you borrow is the amount you're going to use to pay for the call price, and you have to make sure that the amount borrowed covers the cost of the setup of the portfolio. Sorry, the call price is the cost of the way you're going to set up the portfolio, which is the delta of today's price minus the amount you're going to borrow. That's what it's costed you so far to figure out the call price. That's just exactly what you're going to price it. So that's the binomial model, and this is important for the next step up, where this is kind of a one-step model, where this in continuous is called the Black-Scholes model. My handwriting is terrible. So the Black-Scholes model is as follows. Then I'll explain. So C equals SO current T1 minus KE minus RT. This is the CDF like thing of D2. Okay, so what does this mean? So we have current price, strike price. Like we've known about this. This is the risk-free rate is up here, and this is the time to maturity, expiry date. And here we also account for volatility, but it's not seen until we expand on D1 and D2. So D1 is log current price over strike price plus interest rate plus here variance, sorry, over 2 times the maturity date over standard deviation and the the expiry date, the time maturity squared. And then D2 is just D1 minus the denominator. And that would be D2. So the inputs are the strike price, K, the current price, the risk-free rate, the time to maturity, and the volatility. So yeah, here and here. If you give us that, we can model, and this again is this is the CDF standard normal. So like from a table, whatever number that you get, you find on that table, you cross-reference, and then that's that number. This is the binomial model, but if you were to shrink it to like time steps to be so infinitely small, so basically continuous, this formula is better. This looks like a mess. This formula is what you would use. And in this case, this part, the like standard normal of D1, this acts as the hedge ratio that we had, whereas like this S1 in the one-step model. This is the same thing, but just in continuous. This is basically the delta in continuous time. And this part where KE over RT, standard, I forgot, whatever, D2, is the probability adjusted present value of paying the strike price. So this, so you're minusing it by the present value of paying the strike price, kind of like the amount that you borrow. That's like the one-step equivalent of that, which was the second part of it, which was S2 over 1 plus R. Outside the bracket is delta. So Yeah. So okay. So and if we wanted to solve for implied volatility, we would just solve for the standard for the standard deviation from this, which I'm just not gonna do because I don't have time for it. Yeah. So that's options. Just a terrible explainer. Then VOR. This is the last one, the value at risk. So what is the value at risk? The story behind it is the chairman of JP Morgan at the time had traders trading bonds in Hong Kong, stocks in New York, and some other sort of trading thing in whatever other country. And he said, at the end of the day, I want to figure out how much money can I lose if everything goes wrong. So the traders like made up this like whole 50-page thing of all the different Greek letters and like delta this, duration that, all different metrics of the different things they traded. And they found that you can't come up with just a single number using these different metrics, because you can't, for example, like compare delta to the duration. So like when it comes to bonds and stocks. So that's when value at risk was created, where the chairman said by 4:15 a.m. I don't know how real the story is. I think it's real. Said by the end of by this morning, by 4 a.m. I want a number on my desk that shows how much we could lose today. So the number ended up being something like, okay, like they figured out the value at risk model, which I'm about to talk about, and they said, and they phrased it as, okay, we are 95% sure the worst we can lose is like $5 million, or like whatever the number was. I'm sure it was much more, but that's the way that you would phrase it. So I just wanna make sense of that. Yeah. So yeah, that's this. So if you have a confidence, like if you figure out a confidence of 95%, you can say that we are 95% confident we won't lose more than a certain amount in the next 24 hours. That kind of would be the time period. So that certain amount says $10 million. That's the value at risk, and it's the value at risk. Literally, that's literally the value that you're risking to lose for like a certain like percentage confidence. So the probability statement is loss will be greater than var this equals A, where A equals 0.05 and 1 minus 0.05 equals 95%. So this is basically saying that the probability that our loss is greater than our value at risk projection is 5%. So we're 95% sure it's not going to exceed that. That's how you call it. So how do you account for the value at risk? So we have two methods: the non-parametric and the parametric. So parametric, right? Yeah, the non-parametric. I think it means like non-parametric, whatever, non-parametric. So method one, let's call it like the historical one, historical data. So using historical data to figure out value at risk is as simple as, so the VOR equals negative. So okay, so because we've been reusing a lot of the same things. Negative S times RT, where negative S is the total portfolio value. So S being the total portfolio value, right, of today, like minus, like negative, times the history of returns. And the history of returns has to be a list from worst to best. So from least to most. If we have a list of returns and like one of them is like negative 35, that's terrible. But like that would probably be the least thing, and the best would be here. Then, say we have 100 days of data. So we have 100 different days where there's 2.3, 5 point whatever, like for 100 times. So n equals 100. And if the confidence, which it usually is, we go with a equals 0.05, meaning we're doing a 95% confidence interval, then k, which is a new thing, equals a times n, which means k would equal 0.05 times 10. Is it 50% or 5? Oh, sorry, what am I saying? 10, 100. Yeah, makes sense. 100, because there's 100 observations that we made. Then k equals 5. And sorry, this isn't t, this is k. So return k means the fifth return from the left. So from the 100, whatever, the fifth return we land on, let's say that return is -3%. Then we multiply today's portfolio value times -3%. And that gives us our value at risk. That's like and we can say with 95% confidence that is we're not going to lose more than that. And then we have method 2. I literally have to leave because there's an exam. Okay, method 2. Like this is the exam space. But this is helpful, so I'm going to keep doing it. So method 2 is the parametric one. So this, we can call it the normal distribution, the normal one. I'll call it the normal, because it uses the normal distribution. Where var is calculated as, again, portfolio value, negative, times the expected return plus ZA standard deviation. So here the ZA is just the z-score, is the z-score of whatever A is in terms of, like, it's -1A. So this being 0.5, meaning I think it's gonna be like -1.65 or something like that. And if it's like 0.01, it's 2.66, something like that, -2.66. This is average return, like expected return, and the same thing. So the thing about this is we're using the normal distribution. What's good about it and what's easy about it is you don't need a list of 10, 100, a million, n, where you have to list like the return times from least to best. You can kind of just like, you don't need that whole raw data list. You can kind of just go off this, which is good. But what it's bad for is this doesn't account for the other side of the 5%. So like the 1% chance of how bad it can really be. So yeah, it's 95%. It's most probably going to be accurate, like statistically, but it does not account for the black swan events. And the perk of the historical one is it gives you every single data point, so that doesn't slip out. So in that case, it's more effective. But this is just easier, so people do it more. And then finally, two last things. The VAR of the portfolio, so the value at risk of the entire portfolio, is measured, standard deviation portfolio, to be the sum n g equals 1, j equals 1 for the time and whatever many stocks we have, of the weights adjusted and the standard deviation. And what this ends up doing is almost always, or not almost, always, the variance of a portfolio is always going to be less than the variance of individual assets summed up, because that's what we call like I don't know who we use, but that's what's called as the diversification benefit, where no matter what, if you diversify, it's safer than if you just have individual assets. So the VAR of the portfolio is always going to be less than the VAR of, like significantly less than the VAR of individual stocks summed up. And the last thing is rescaling. So after this whole VAR thing, the Basel Committee, which is some regulation that was placed on banks, said the Basel Committee basically said that banks need to have a certain amount in their, like certain amount of cash, depending on their value at risk. So to make sure that they never run out of money, or it's never a critical amount. So the committee, for example, says we need your 10-day VAR, your 10-day value at risk, while banks usually, because it's just more efficient, calculate their 1-day value at risk. So what do you do if you need your 10-day value at risk, given you already calculated your 1 day? You don't go back and recalculate. You just get your 1-day VAR, and then you multiply it by the square root of the time, which would be 10, which would be the 1 VAR times 3.16. And if that, I'm not about to do it. But yeah, so you don't need to just redo the whole thing just for 10 days. You can simply just do it by square root of time, which is very efficient. It's very easy. And the whole reason why that was done was because of the Basel Committee. And that basically sums it up. Thank you for enduring me. And I don't know who's going to watch this. But yeah, wish me luck on my exam.